All right, thanks everyone for joining today. Today we're doing a fireside chat with Utsav Mitra. Utsav is a so I'll introduce Utsav very quickly to the group here, and we will have, of course, a few people stream in over the next 2 to 5 minutes. But for the interest of everyone who's on the chat right now, Utsav is a managing director of Alpha Wave Global. It's formerly called Falcon Edge Capital. Manages about $18 billion across public and private investments. Utsav has led or co-led most of Alpha Wave's private investments in India, and they sort of span across sectors, including SaaS, fintech, consumer internet. But the fund does have a flexible mandate across stages. Prior to Falcon Edge, Utsav was an investor at Prince Street Capital, managing their long and short book in Asia, excluding China. And earlier in his career, he was an investor in Bain Capital Private Equity in Mumbai, and also started his career at McKinsey and Company. He also worked in Narendra Modi's prime ministerial campaign in 2013 and 2014, and then served as an officer on special duty to the Minister for Power, Coal and Renewable Energy in the Government of India. He's also gotten his MBA from Harvard Business School. He graduated with honors in economics at the University of Delhi. So, Utsav, thanks a lot for being here. I must say that
Thank you for having me.
I have been familiar with you for a while because I followed you on Twitter back in like 2015 when you were still working with Minister Goyal, and then you'd moved to HBS. So it's really good to see this come a full circle. And finally get a chance to have you here and talk to some of us. So Utsav, would love to get started by giving you some opening, giving you time for some opening remarks. Can you walk us through Alpha Wave Global, what the fund does, what do you do at the fund, what your strategies are, and what your investment thesis is, and then we'll take it from there.
Absolutely. Look, we started as Falcon Edge Capital in 2012. We started with the partners of the fund. Rick Gerson was a founding partner at Blue Ridge Capital, which was the first Tiger Cup, started by John Griffin. Co-founder by Navroz Udvadia, HBS class of 2005, worked in Eaton Park, and then joined. So the fund started as essentially public equity long-short investing. And then over the last 5-6 years, we've been focusing more and more on the private side. While the public side continues as is, with the focus on special situations investing, but the private side has really grown over the last 5 years, essentially from zero. But most of the growth we've seen in the last 2-3 years. I've been with the firm for about 3.5 years. We are about 20 people on the investing side. Roughly 10 and 10 split between public and private. There's a fair degree of overlap. I mean, even though it looks like we are siloed in different teams, there's a very active cross-pollination of ideas between the teams. I work closely with Navroz. Navroz is the co-founder who heads all of our private investments, and Ryan heads all of our public investments, and Rick is the main founder of the firm, so to speak. I probably co-lead 90% of the private investments that we've done, at least in terms of quantum of capital. We've deployed $3-4 billion by now. On the private side, the new fund is $10 billion as of second close, and we expect the third close to be a little ahead of that. So that's a quick overview on us. We have about 120 private companies, of which 75% right now are India, 25% global, so US, Europe, China, Southeast Asia, etc. I think going forward, even though we don't have hard sector or geographic allocations, I expect some combination of US probably being 40-45%, India continuing to be 25-30%, and the remaining 25-30% getting split between Israel, Indonesia, Europe, and probably some parts of Latin America. The team is lean, so
So
it's
could I just quickly clarify? You mentioned that you had about 70% of your current investments based out of India, but you're saying going forward, you'll bring that down to about 25%. Did I understand that correctly?
That's right. The reason is, out of a 10 billion fund, you can't invest $7.5 billion in India in a 3-year period, right? So then, and our mandate is global. So the plan is to invest in world-class tech businesses around the world, and we do across stages, across sectors, across geographies, right? So we have a pretty clear mandate in that sense. It's not an India-only mandate, but clearly, when you're building out a franchise, you have to start somewhere. You have to have at least some demonstrated areas of experience and expertise. For us, that's been India, but it's also over time been India, Indonesia, and Israel, right? So I would say 85% of our investments probably currently are in these 3 markets. But going forward, I think the India contribution as percentage of total will reduce, not because we are not optimistic on India, of course we are, but just the quantum of capital raised plus the global mandate. I think what this means is we'll just end up doing a lot more of Europe and US, wherein we are actively building up our teams.
Interesting. And before I ask you to also just share a little bit about your journey, about your time at HBS, and how you were thinking about careers and how you went into AlphaWave, there have been a few more people who have joined the chat. So for your information, we just got started. We're still at on introductions right now. The way we plan to structure this conversation is that I'll lead the Q&A. I'll lead the sort of fireside chat for the first 45 minutes. And broadly, I want to cover 3 to 4 themes. One around Utsav and AlphaWave's investment thesis. Second, about their current portfolio. And third, a little bit about Utsav's own understanding and views about the Indian market. So I'll cover these 3 broad areas, and then I'll open it for Q&A. So please keep your questions ready. And then, I think around the 45th mark, we can start moving on to Q&A. And then finally, Utsav will spend a couple of minutes talking about an internship opportunity that they're still thinking about. I don't think it's been finalized yet, but Utsav will be happy to sort of tell us a little bit about that. So Utsav, with that, so the second part of your introduction, would love to hear about how you thought you worked in consulting, then you worked in private equity, then you worked on the prime ministerial campaign, worked in government, then came to business school, and then moved to investing. Can you walk us through how you've sort of played your career out so far? How come you made the choices that you did, and what that journey was like?
Absolutely. Look, I've always been intrigued by politics as a means for large-scale social impact. Even in college, I was the college president. I went to Sri Ram College of Commerce, SRCC in Delhi. And so elections is actually a pretty big deal there. And I was always fascinated by the process, contested elections, managed to win. And then I did the usual McKinsey and Bain Capital. For those of you from India, you would know that 2011-12 period was a time when all these major scams were breaking out in India. There was the Anna Hazare movement, India against corruption, etc. Massive pan-India movement starting out. And then a bunch of people like myself, I was 23, 24 then, actively participated in those protests. There was no Aam Aadmi Party, etc. So then, along with working for Bain Capital, and also, coincidentally, Mitt Romney was then running for president for the US. So then, taking a step out of Bain Capital and working in politics was kind of a socially acceptable thing to do inside of Bain Capital, right? So I did that, worked with politicians for about 12 months, even when I was a part of Bain Capital. And then I got pretty close to certain senior leaders in the BJP. By the way I got connected was through cold emails. So never underestimate the power of what cold emails can do, because I don't come from a political family. I was just passionate about the cause. And I reached out to about 50, 60 people. And then a handful of things happened, one after the other. And I managed to break in. Then I spent a year working on the campaign with Mr. Piyush Goyal, who was then the leader, who was then in the opposition as a Rajya Sabha MP, which is the upper house in India. He was the treasurer of the party and a key member of the campaign committee. So I worked with him and Mr. Jaitley for a year for the campaign. Obviously none of us knew what would happen in the campaign eventually in terms of the outcome, but Mr. Modi won. So then Mr. Jaitley became the finance minister. Mr. Piyush Goyal became the minister for power, coal, and renewable energy. And that's when and I was thinking about applying to business school. And Mr. Goyal said, "Why don't you work with me as an OSD?" OSD is officer on special duty, basically like a chief of staff role. So he said, "Why don't you come and work with me for a year? The experience will surely be great. And I know you want to go into business school. If anything at the margin, it'll probably help your story and your application." So I said, "Why not?" And I was 26 maybe at that time. Yeah. I was financially independent. Nobody was dependent on me. So I thought that, another year of doing this was a risk worth taking. And it's not really a risk. It's just some, 12 months of very limited salary, which is fine. Did that, luckily managed to get through HBS, came here. Harvard Kennedy School, for reasons unknown to me, rejected me. Can't help it. But so my original plan was to do the dual degree program, but then it ended up with HBS alone. Can't complain. And then I would say early 2015, I got in touch, or maybe this was 2014. I got in touch with Navroz Urvadia, who is the co-founder of Falcon Edge, right? And we originally met in a work context, and then he became a friend and a mentor. He was asking me, "What do you plan to do with your life?" And then I said that, "Look, I've done consulting, I've done investing. Long term, I want to, serve my country in some shape or form, but it's this interim that I don't have a particularly strong view on." And he said, "Why don't you come and work with me over the summer? If you like it, you can do more of it later, and then eventually, of course, we'll all come back," because he also happens to be extremely passionate about serving the country. Now coming from highly structured environments, so consulting and private equity, for those of is analyst, associate, senior associate, or VP, principal, director, MD, maybe senior MD partner, right? So it's a 6-7 tier system. And then during my internship at Falcon Edge, this was just before my MBA, when I was working with Navroz, it was a completely new world to me, wherein all analyst to principal is essentially compressed to one single individual, right? So the amount of responsibility each individual is given is immense, because you're just reporting to one of the partners in the firm or one of the co-founders. That amount of responsibility was quite thrilling and amazing. And there's no hiding. There's no additional layers. There's no unnecessary deck making, model churning, just because your VP wants 5 additional pieces of analysis to run. It may or may not be relevant. There's no bureaucracy. There's no creation of work for the sake of showing work, etc. And there is pinpoint accountability. So that really inspired me. I said that, look, this is a great setup. I love this. Why don't I do this ideally post MBA to the extent I'm able to make it in? So then I made a conscious choice of actively recruiting for hedge funds, not because I knew a lot about public equity, long short investing, but because the organizational structure appealed a lot to me. This significant accountability, responsibility, lack of bureaucracy, full transparency, etc., appealed a lot to me. Recruited for roles like that. Interned at Carlyle's hedge fund over the summer. It's called Emerging Sovereign Group. Did that post MBA. Took a job at Prince Street Capital. Falcon Edge wasn't hiring at that point. And then a year after I graduated, Navroz called me and said, "Why don't you come and join me full time?" Now we're actually looking to hire, because they weren't hiring at the point when I was graduating. So to that extent, a lesson for many people is that, persistence, pace, be in touch with people, who you've interned with in the past, who may not have had a spot for you when you were graduating, but if you had a good equation with them and you genuinely enjoyed working there, be in touch. Don't burn bridges, etc. Be nice, and then the opportunity will just, well, at least in my case, it did show up, and I do know that it's happened to many others as well. So when Avroz called me back, it was a clear sense of that, look, we want to build the India private business. At that time, we had 5 or 6 investments, Ola, M-Swipe, JM Credit Solutions, Housing, Quicker, and a few other investments. The plan was to grow this manifold. And then this was middle of 2018. We said by 2021 or 2022, we want $2-3 billion franchise focused on cross-stage private investing in India, and then be able to show attractive returns. That appealed a lot to me, plus the combination of directly working with a co-founder, significant responsibility, etc. I moved from Singapore to London, and I've been doing this ever since. Now, even though we started with India, now I do everything. I've led 4 European deals, basically all 4 that we've done: Revolut, Klarna, Monzo, and Getir. I've led a handful of US deals, Israel deals, Indonesia deals, China deals. So my role is among the best. I feel extremely fortunate. I'm not saying this because I'm in front of a broader audience, but this is something I tell all my friends, is that this is as close to a dream job as it gets, because I have a ringside seat into investing substantial capital with some really smart people, and being able to do so without constraints, i.e. across stages, across geographies, and across sectors. In most firms, you get siloed. You are an early stage person focused on healthcare in India. You're a growth stage person focused on consumer tech in Europe, et cetera, and can even get further siloed. I think one of the rare privileges of my job is that I get a fairly broad view, and of course, to some extent, I can choose how deep I want to go to within specific sectors or geographies or stages, etc. Personally, look, the way portfolios get constructed, especially when you do cross stage, is that most of the dollars end up being growth and late stage, even though the investment count may end up being on the early stage side, right? Because your average early stage check is a $5-7 million check, and your average growth check is, let's say, $100 million check. So then you're doing 20 Series A investments, is equal to 1 growth check, right? So that's how the math just ends up looking, right? So even if you do, 200 investments from a particular fund, the way the portfolio skews from a dollars perspective is the exact opposite of how it skews from a deal count perspective, right? So it's 80-20 from deal count, but it might be 20-80 from a capital deployed. And I just find that fascinating. But I enjoy investing across stages. And I guess the joy in some senses on investing in early stage is that you see a handful of companies which you've backed when there was really nothing much in the place apart from a large market and a high quality founder, but not much in terms of the actual business. And then you see that business blossom over time, and hopefully you've had a small role in shaping that outcome. I think that is quite fascinating to me, at least, because then you're doing the A, B, C, D, E, and then you continue seeing the company through to IPO. Late stage is also good because you're fundamentally playing in a space wherein the companies have kind of broken out. And so you're already playing in a rarefied field, right? And so there it's a question of, yes, we've come so far, but what next? And a handful of companies will cross the chasm and some won't. And essentially most of the diligence and our attention is focused on that. But when we see some of these companies wherein you entered at seed or Series A, really go through the whole journey, at least I find it personally very fulfilling. And that probably goes to the last part of my career, last part of my career interest in terms of how all of this ties in together, is that I'm quite fascinated by impact. And especially when you see a small group of people driven by a strong mission being able to accomplish something significant, that to me is extremely gratifying. And if you're able to do this in a variety of contexts, I mean, it can be in a business context, it can be in a nonprofit context, it can be in a political context. That is gratifying. And then the question is, how are you being able to scale it and so on? But I think my part one of my career was learning. This part two is currently doing, and then there'll be a part three, which will be giving back. We all will have very long lives. We'll have 85, 90, probably even 100-year lives. So then, there is significant benefit to long-term thinking, and to think about not what we'll just do in the next 1 year, 2 years, but also 5, 10 years, but also there's a 30, 50-year plan. I read a book, I guess 3, 4 years ago on this topic. It's called The 100-Year Life, which sheds a lot of light on this and really shaped my perspective on how to think about life longer term.
Yeah. Well, no, thanks so much for such a comprehensive introduction. I almost had a smile on my face just listening to how you moved from role to role, and I think you're one of the very few people who might have seen investing from multiple different angles: structured private equity, hedge funds, early stage investing, and now growth stage investing as well. So very unique perspective that you must bring to your job. And a couple of things that you brought up during your intro, the Harvard Kennedy reference. So we have a couple of people from Kennedy who are on the line. I see them here, Surbhi, Gopal. I'm sure they must have had a smile on their faces when you brought up the Kennedy School reference. And then there's Kaushal on the line, who's also Bain Cap. So he shares a bit of history with you there. So thanks so much for sharing your story. I guess in the first piece that I wanted to cover around your investment thesis, your investment process, would love to know how you think about writing your checks, whether they're Series A or growth checks. Is it that you think about what the world might look like 5, 10 years from now, and then you reverse engineer to think about, okay, these are the kind of companies we should back today? What is your investment criteria? What do you really look for when you're writing these checks, especially when you're doing it across stages and across geographies where legal constraints, regulatory constraints, etc., might be very different? So walk us through one. How do you look at the process in terms of timeline, whether this business will grow 5, 10 years from now, and then second, just across stages, across geography, what are your investment criteria?
Absolutely. Let me answer the question in 2 parts because the answer varies. One is, let me take a stab at what a growth investing check look like, or a growth investing diligence process looks like, and then I'll give you a sense on early stage. There are areas of overlap, but then they don't fully overlap. So for growth, there are probably 4 or 5 things we look at. First is size of the market. To say that, look, yes, the company has grown so far. We all get it. We can see it in the numbers, but how much further can this grow? How large is the market? How much further penetration, market share, etc. Can this support? And if you look at the business 5 years out, 7 years out, what are we really shooting for, right? But the answer really comes down to TAM, right? So total addressable market of the business, company solving a really large scale problem such that the outcome of the business is large, right? So that's probably the first thing you're looking at. Second thing is, in the growth stage, you have the benefit of looking at a lot of numbers. So then you look at unit economics of the company pretty closely, whether it's a SaaS business, consumer internet business, etc. The company may not be profitable on a headline basis. So when you look at the P&L or the cash flow, EBITDA may be negative, cash flow may be negative. Sometimes EBITDA positive, cash flow negative. Reverse is rare, even though it happens. But what you're really looking at is a company profitable and really attractive on a unit basis, right? So we spend a lot of time looking at it. Sometimes it may not be profitable at the unit basis even then, but then you might have significant confidence that over time it will be significantly profitable at a unit level because of X, Y, Z factors. And you should develop significant confidence and conviction on those parameters. third, I would say, is quality of competitive moats. Quality and strength of competitive moats is that sometimes economics today may be great, but then the question is, are they defensible over time? And sometimes it may be that, look, the company is deliberately under monetizing because it's currently building up its moats. It can be technology, supply, network effects, et cetera, et cetera. So then are the moats really strong such that in future, when the company really wants to monetize well, that these attractive economics will be defensible, right? So I would say this is probably the most important part of the diligence process, and it's the hardest to factor in and the hardest to train for because you can't necessarily look at numbers. I guess the second piece is the easiest because any smart analyst can quickly crunch numbers and tell you how numbers are looking like today. But that's not the point. The point is how will numbers look like 5 years out, by the time 5, 7, 10 years out, depending on your investment horizon. And that's often a function of competitive moats and the quality of the founder and the team in their ability to continue to strengthen the competitive moats of the business. And then finally, is the valuation attractive enough such that you're able to make a 3x to a 5x on reasonable exit assumptions? Reasonable exit assumptions doesn't mean putting arbitrary revenue multiples. For us, it's about looking at, EBITDA and ideally cash flow at exit, saying that, are you effectively buying the business at a low multiple of future cash flow? If so, and if the first 4 parameters stack up, then it's probably an attractive investment. If not, it's hard. And often you'll come across businesses which might be great from an EBITDA perspective, but terrible from a return on invested capital or from a cash flow perspective, right? So ultimately, value of a business is present value of future cash flows. That's not something that people should forget. Things like GMV multiples, revenue multiples, DAO multiples, MAU multiples, etc., are all things people talk about in a bull market. But ultimately, corporate finance does matter. And so cash flows are something, future cash flows. I mean, the company may not have cash flows today, but future cash flows are something that we focus on. And the capital intensity to achieve those cash flows, i.e. the return on invested capital, is something that we focus on. So I would say these 5 things are paramount if you're doing 100, 200, 300 million check in a late stage asset from our perspective, right? So examples from India would be Lenskart, Moglik, Swiggy, Delivery, Pine Labs, etc., etc. I mean, Dream11, Off Business, all of these are world-class businesses. All of them are leaders in their respective categories. All of them are run by high-quality founders with great commercial sense, integrity, etc. In our view, all of these businesses are building strong competitive moats. In our view, all of them, at least at the point of investment, had a reasonable valuation, at least from our perspective, from the perspective of being able to generate significant future cash flows. So once you put everything together, probably there's a pretty strong and compelling case to invest. Now, the difference with early stage, while some of these factors hold, not all of these factors hold, because you generally don't have enough data, and if anything, sometimes data can be misleading because you probably have sold to only a small set of friendly customers or like highly cherry-picked customers, right? So, your cohorts may end up looking much better today than they would 5 years out or 10 years out. Or your sales cycle, if it's an enterprise SaaS business, may look shorter than how it would look like at scale, etc. Right? So you have to think about a lot of these things, knowing fully well that the data today, the data set today may be short. So what we focus on is that the market has to be very large, goes without saying. Second, I would say founder quality, founders' ability to attract high quality people is paramount. Of course, nobody will go and say that, look, founder quality doesn't matter in late stage or in a public company. Of course it does. But on a scale of, 0 to 10, it's probably a 10 on 10 issue in the case of an early stage business. In later stage businesses, especially if the company is well run, a lot of the level 2s become fairly empowered in order to be able to run the company on essentially on an autopilot basis. But in early stage, founder and probably the 5-10 people around the founder are absolutely critical. And how you judge them is honestly qualitative. There are, it's really hard to pin down quantitative ability, quantitative ways to come up with saying that, look, team A works, but team B doesn't really work, so we'll go with team A. So that's a lot of craft. And from that, you think about competitive modes, because at that point, competitive modes don't exist. So really talking to the founders, as well as doing work around the ecosystem to figure out what could competitive modes be over time, and can these founders build those competitive modes over time in order to generate attractive economics over time. It's basically that. And then finally, valuation, of course, matters, but then question is, often it's less a question of, okay, I'm paying this multiple of revenue, because 9 out of 10 times you don't have EBITDA or cash flow at that point, but more about, okay, so what's the absolute size of market cap today relative to the opportunity, right? So you're thinking, okay, the company only has 1 million in revenue, but I'm paying 100 million valuation. So you're not, I mean, even though it might look like you're paying 100 times revenues, that's not how actually this works. You know, the way you often think about it is, okay, I'm getting what could be a likely winner in this space for $100 million valuation. Businesses like these in other parts of the world have created 20, 30, 50, $100 billion valuation. These are the common sets of market conditions that I see in this country. This team seems well poised to be the number one or number two. Therefore, you know, 100 million valuation in that context is not outlandish, even though the company only has 1 million in revenue. Because you're not going to get it for 7 million or 10 million, right? I mean, you have to be practical about your ability to even engineer a deal. So this is how we think about it. I'm sure this is not the only way to succeed. There are many smart people in early stage, but this is just a framework we use.
Yeah. So you went into a lot of detail about the investment criteria that you use across both growth and early stage. Can you tell us a little bit about your investment thesis? Again, you know, is it a top-down thesis where, okay, this is how we envision the market to move in the next 5 to 10 years, and therefore let's reverse engineer and find opportunities that fit our worldview? Or is it more opportunistic? And then as a second part to that, how do you source your deals in either of these approaches?
Look, investment portfolio construction is always top down and bottoms up. There'll be certain sectors wherein you will go and map out exhaustively top down, right? So, you know, as an example, we are doing it right now for the Web3 space, right? So now we're meeting all of the layer ones, we're meeting a handful of layer twos, we are meeting the dApps, we are meeting the multiple infrastructure and tooling plays, and then trying to pick the best of each, and then seeing how the portfolio becomes synergistic over time, right? So it's essentially a top-down approach, but you're exhaustively mapping the market out. This is a good way to invest, in our view, but not the only way to invest. I think what ends up happening in the real world is, for a handful of sectors, you would invest this way, and for a bunch of others, you would be a bit more reactive, saying that, look, a certain company that we think highly of is raising. So then you'll spend time on that company. But as you are spending time on that company, then you end up mapping that whole competitive landscape anyway. So it's not always organic and outreach based in that sense, even though that probably gives you a lot more confidence and helps you build your conviction. Because again, the real world issue often is that many good deals get done in a very short amount of time. You might only have 2 or 3 weeks. So then you will not necessarily have the time to do a full blown like diligence wherein you're meeting 20 competitors, in different parts of the world, extensively studying, okay, what happened to this business model in China, not today, but at this current scale, which is probably in 2014, you may not necessarily have the luxury of time. So sometimes market just pushes you to move faster, so you can't be mechanical about it. You have to have a certain amount of commercial sense, but I would think it's a combination of both, and not one or the other. Left hand to me, I would do more of the former and less of the latter, i.e. more of the thoughtful top down and bottoms up sector mapping and less of the reactive stuff. But it's probably 70-30 for us. I hope we do more of the former. In terms of timelines, look, I think it's highly variable. And generally there are red flags of all kinds, right? So if someone sends you a deck with like a November 2021 timestamp on it, and you're sitting in April, now you know that, look, the company has been in the block for the last 5-6 months and they haven't been able to raise, right? Which is a red flag in itself. Nobody needs to tell you that, but just a lot of those simple things make it pretty clear. Oftentimes, you will see that the company's cap table on paper is great, but then the company is being shown to you, and you'll wonder why. Because the best deals aren't necessarily shown to you. You go and find the best deals, right? So the industry is plagued with what we call adverse selection. And the way around adverse selection is if you have a fairly well thought out, sector strategy, so that you're seeing the best assets in that space that you're covering already, so that it's not a surprise per se. But usually I would say 3 to 4 weeks is a typical diligence process from the first meeting of a company to maybe term sheet. Then maybe about 4 weeks for the post term sheet diligence process, wherein you're running a financial DD, legal DD, you're finishing up any other confirmatory commercial points. You're also negotiating the shareholders agreement, share purchase agreement, etc. Maybe there are certain secondaries going on, so buying those up in parallel, and then end to end, it's probably I would say 45 to 60-day process.
Okay. So, when you were in your not in your introductory remarks, but when we were talking about your investment criteria, you also touched upon valuation, and you said that, hey, listen, we are willing to buy something where, if assuming reasonable exit assumptions, we make about 3 to 5x of our invested money. So talking about exit, so you've been with AlphaWave, Falcon Edge for about 3.5 years now. Not the amount of time that one would typically get to see through the life cycle of an investment, but to the extent that you have and to the extent that you can share, would love to know how exits have panned out, if at all, in your portfolio. Have you been invested in companies that have gone into IPO, or if not through the IPO track, because that's kind of been a little lackluster in India? What other exit opportunities do you really see? Do you have to go and market your portfolio companies via investment bankers? You just get inbounds from Indian conglomerates or big tech, based out of America? What does that process look like for you?
Yeah. So look, I would say we are quite fortunate to have LPs and capital partners who have a very long-term horizon. All of our funds are 10 plus years in terms of investment life, and then we have probably 2 1-year extensions, right? So you're really talking about an 11-12-year fund. So to that extent, we are quite fortunate that we don't have a pressure to exit. That said, of course, we are duty bound to return capital to our LPs, and we aim to do so whenever it makes the most commercial sense. So even though I've been here for 3.5 years, most of our investments are recent, right? So and we're quite optimistic about the future of those companies. So we are not in a in any kind of rush to sell, but certain companies which are probably 5-6 years old in our portfolio, I think it's just good process to start returning some capital. And the way we think about it is, you first return the principal, right? So let's say someone's given you $100, you first return that, then you return the hurdle. Many funds have a certain hurdle rate, 5%, 6%, 7%, whatever that may be. And it's often a compounding hurdle, right? So then you have to beat that. So then you return that, and then you gradually exit the whole portfolio over time. But again, your duty is also to maximize returns, right? I mean, you don't want to just liquidate ASAP because, okay, now the fund is at a 2x. Maybe the fund's potential is actually a 5x. So it's actually not commercially the right thing to do, just to exit ASAP. But then there is the MOM versus IRR trade-off in that yes, you can theoretically continue maximizing MOM, but then it comes at cost of IRR if it's extremely long dated, right? So then even though there's no perfect way to do this, we think about, at least in our base case, especially for companies 5+ year in our portfolio, we think about what the right time for that exit is. And look, we are not optimizing for ourselves. Many times it's the wrong thing to sell. It may not be the best thing for the business to have a key investor like us sell. In that case, we'll just wait, right? And we'll just wait for the right time and the right market conditions to sell. I think it's something that, so much is written and spoken about investing well, so little is written and spoken about selling well. I think it's something that we need to honestly, we as well as large parts of the industry probably need to get better at. But I think most founders understand that once you've been an investor for 5-6 years, there is some duty to, on the investor's part, to at least start selling small pieces of the stake. You don't have to exit your entire position, and your entire position may be, let's say, 15% position, i.e. a 15% stake. But maybe 5% of stake probably covers your initial capital, assuming that you're sitting on a 3x, right, for argument's sake. So then you sell 5%, you still hold on to 10%, and then as and when the circumstances permit, and it's not a bad thing for the business, the market conditions are ripe, then you can gradually get the rest of it out. I think the private equity players have been extremely disciplined about this, which is something that we admire.
Yeah. So I have 2 more questions, one around your current portfolio and your portfolio ops and the strategy around that. And then I'd also like to ask you one question around your views on the Indian market. And then, if anyone on the line has questions, please think of your questions and raise your virtual hands, and then I can call on you after that. So on the portfolio side, you mentioned that you have now started investing in other parts of the world, and that's how your mandate has basically broadened. So the question is that because your LPs have just found you all to be great investors and have entrusted you with more capital to invest around the world, or is there some other strategic play, chiefly being, hey, you guys are investing in companies that are building on Indian cost structures? Can there be synergies between the products that are being built out in India, and can you apply them to use cases or through different channels in other markets, whether they're in Western Europe or wherever else? So is there any synergistic play in your mandate, and how does that sort of play out for you?
No, absolutely. Look, it's a combination of multiple things. It's a combination of the things you said, as well as us having developed a pretty strong pattern recognition, not just from a public-private nature of the firm, but also, having looked at a number of fintech businesses in India, we are able to evaluate, virtually every fintech business in every part of the world, right? Or having looked at food delivery, extremely closely in India with Swiggy and Zomato, our ability to evaluate food delivery businesses around the world, just goes up. It's basically the same business, right? Similarly with grocery delivery. Right now, how did we land up at Getir, which is the leading European, quick commerce company, is because of our work with Swiggy and Instamart in India, right? So that gave us a lot of confidence and conviction that the business model works. Then we looked around globally. We did a global sector scan, and then we invested in Getir, which in our mind is one of the best run players in the space, right? So a lot of our LPs, I would say, began to recognize that. I shouldn't tom-tom myself, tom-tom our prior success, etc. too much, but it's a combination of pattern recognition, public-private, having developed certain sector, I shouldn't call it expertise, but call it experience, or in-depth sector experience in a handful of sectors, consumer internet, fintech, financial services, SaaS, etc. And then our LPs entrusting us with more capital to deploy. Looking at our track record, which was largely India and a little bit of US and a little bit of Europe and a little bit of China, but then saying that, look, you've been able to do this at this current scale reasonably well. Why don't we agree on a mandate, and you can deploy this capital?
Yeah. Do you see that play out though, where eventually, maybe not today at full scale, but eventually, do you see that playing out where in the 80s and 90s, we had this consulting model where TCS, Infi, etc. They basically did outsourced work on Indian cost structures for Western companies. Do you see that play out in the sense that you build the whole product tech stacks in India and just market and sell them in the US? Is that something that's on your horizon at all, or is it too
We see that in SaaS.
Yeah.
We see that in SaaS a fair bit. But honestly, globally, the best product wins. And cost structure is obviously important, but it's not the only thing. In that, if you're a buyer sitting in the US, and let's say a world-class product is available at, let's say, $100, and then a decent product is available at 80, I don't know if the purchase decision gets made on the 100 versus 80 or the 100 versus 50 even. I think a lot of people are just focus on the product efficacy. Of course, all things equal, assuming that the product efficacy is the same, usability is the same, security, etc., are similar, the level of customer support is similar, etc. Obviously, then there's no reason for someone to pick a more expensive version of that product relative to the cheaper version of that product, because everyone operates on a budget, right? So we've seen that theme a lot. In fact, a lot of India SaaS started that way, but I think increasingly it's becoming, more, PLG, as people call it, product-led growth, wherein it's not just the cost arbitrage that you're playing on, not to say it's not important, but wherein the best product wins. And if you're able to deliver that with the best cost structure, obviously, that is nirvana.
Yeah. So I've received one question from Kaushal in the chat. He mentioned that he's in a noisy environment, so can't go off mute. I'll share his question in a bit. Final question from my end. Two-pronged question again. One, what are the companies in India in your portfolio that excite you from a growth standpoint? It's almost like asking you to pick one child out of the many people that you've invested in. But if you can share a few names with us of companies that excite you and why, would love to know that. And then the second piece is an extension of that. What is your top-down view? The one that we were talking about earlier. What are some trends that you see play out in the next 5 to 10 years in India or maybe even globally that excite you?
Yeah. Look, picking portfolio companies is extremely hard because we have 120 of them, and naming 5 is doing disservice to the remaining 115. But let me talk about, I don't know if I should fall into the trap or not. Look, the way I would say it is, I think the growth companies are all kind of cherry-picked. They are in some ways de-risked because most of them are industry leaders already, right? So Lenskart, Swiggy, Dream11, Delivery, Policy Bazaar, Moglix, Off Business, Cred, Daily Hunt. These are all category leaders in themselves. We are extremely optimistic on their prospects over a 3 to 5 year period. They're all run by very high quality, exceptional founders, great teams, path to fantastic unit economics, very robust competitive mode. So everything we like in terms of what we look for in our investment thesis, all of them check all 5 boxes effectively, right? So, and on top of that, execution post-investment has also been pretty spectacular. We are extremely fortunate to be partners there. I think what's also interesting is to see a handful of your early stage businesses, which you got involved in seed or Series A or sometimes even a B, when they cross the chasm. I think that's also extremely fulfilling. It often takes a lot more work, but it's great to see it when it happens, right? So we've seen Class Plus do exceptionally well. Mensa, which we seeded middle of last year, has now attracted very high quality capital, kind of the fastest unicorn in India. I don't know if we should celebrate that or not, especially in these markets, but I would say, the performance has been exemplary. They have performed far ahead of, let alone our expectations, but their own expectations. Deal share grew 30x year on year last year. So So when we see a handful of these, I think personally, I find it very fulfilling.
And then the second part of that question was, what are some of the trends that excite you from an India standpoint, like an overall market standpoint, market evolution standpoint? And by the way, thanks for sharing those names, despite feeling like that was a bit of a trap question. Appreciate you still sharing some names out.
Yeah, look, we are extremely bullish on India. There are a few top-down things, why, top-down factors that drive our excitement, but I'll also tell you certain things that we actively watch out for, right? So look, India's demography, low cost of data, pretty good regulatory environment, Aadhaar, etc., are all things that we're excited about. The overall tech market cap in India, public plus private, is probably, I don't know, $150 billion or thereabouts. China pre-crash was 2.7 trillion. Granted that China did not let Facebook, Google, Amazon, etc. play there, granted. But even adjusting for that, you still have pretty material delta in terms of tech market cap in India relative to that you saw in China pre-correction, right? So then, if you and there are a number of ways to cut this data, but when you do this, you'll see that China is probably 6 to 7 years ahead of India in terms of penetration of e-commerce, online shopping behavior, payments penetration, smartphone penetration, etc., right? Now, so if you then extrapolate India today to India in, let's say, 2027 or 2028, and then you drag it forward, question is, where could we end up from a market cap perspective within tech? In our estimates, I think that number is somewhere between $700 billion to $1 trillion. So you're talking about tech market cap itself from 150 going to kind of 700, 750, so 5x, to potentially a 7-8x. So this is the single largest opportunity that at least those who understand India or have a way to play in India, in my view, should play. Because opportunities of this size don't come every time. I mean, it's almost a once in a generation opportunity. People have access. You can deploy substantial amounts of capital, and it's scalable. People speak English. You can analyze the data. The regulatory setup is good. You can actually go and see this happen right in front of you. So this is something that we are honestly very excited about. I think the single biggest driver to this is India's per capita income continuing to increase in dollar terms. I think that's the single biggest variable. If that slows down, it's not like the outcome is not going to happen, but it'll probably get stretched out much further, right? So then you won't probably see it in 2027. You'll probably see it in 2030 or 2032. Not the worst thing, but obviously you want it to happen sooner rather than later, because the percolation effects of accelerating per capita income is immense. I mean, it cuts across society, dramatically reduces poverty, increases people's ability to consume, ability to invest in education, healthcare, infrastructure, etc. Government taxation income goes up. The spillover effects are pretty phenomenal. So if India is able to hit $5,000 per capita and then $7,500 per capita, there's obviously PPP unadjusted. You can do the adjustments for PPP, so call it 10,000 and 15,000. I think we'll be in a very, very good place. And the underlying India bet is that per capita income in dollar terms will continue to accelerate.
Yeah, great. So thanks for sharing that. So I'm going to read out Kaushal's question. He sent it to me in a direct message. So he's saying, you pointed out a few example red flags that you look for when you're evaluating companies. Can you elaborate more on that in terms of financial profile, business model, founder team, and competitive dynamics? What might those red flags look like?
Yeah, so the financial ones are quite easy. You see companies. This is not an India issue, by the way. It can happen to any company in any part of the world. but often you see companies aggressively booking revenues, not collecting cash against it. And so then your receivables continue to build up, right? So I guess a lesson is to then focus on balance sheet and cash flow with as much attention as you look at the P&L, because all of these skeletons are generally buried in the balance sheet, which you end up ultimately seeing in the cash flow. Because if your revenues are increasing at a certain rate and you're seeing the cash flow conversion not following, assuming the cost structure is something that you have a fair degree of comfort on, those are things that reveal themselves pretty quickly. Capitalization of costs many times is a classic issue. A lot of people tend to upfront their revenues, defer their costs. A lot of companies tend to, this example would be for lending businesses. When they're aggressively growing the lending book, booking processing fees as well as the names upfront, but the NPAs happen with a lag. So your P&L continues to look good, right? So then you have to think about how does this business look like when you look at loans on a cohort by cohort basis or on a customer by customer basis, because then the impacts of growth essentially get taken away, because growth can mask a lot of skeletons. And I guess the job of a good analyst is to be able to, if not uncover those skeletons, at least be aware of where those skeletons could be buried, and then go and look for them. And after that, you might take a call saying that, look, this is a risk worth living with, which is fine. I think sometimes the danger happens is that you don't even know that a certain skeleton is buried and it gets uncovered post-investment. I mean, then the entire investment team looks pretty stupid. Then you'll find many companies booking aggressive GMV growth, but then when you look through the transactions, you'll see that maybe these are offline transactions that are just getting booked online, right? So example, let's say you bought a used car from a dealer. One of these platforms went and said that, look, this transaction happened on my platform. But what he did was, well, actually the transaction did not happen on the platform. Some sales guy of that used car website went to the dealer, paid him 500 rupees and told him that just book this transaction online, right? So often you might be misled into believing that a lot of people are actually using this platform, whereas they may not be. So on-ground diligence reveals a lot of this, but just having a, I guess being alert, in terms of the actual diligence process is extremely helpful, especially in areas like these. These are the financial ones. Then the adverse selection problems are numerous, right? So often you'll have someone from a bigger fund or a different fund who are not close to on a day-to-day basis. Usually when they send you a deck, if they loved it a lot, they would do it themselves or they would show it to their closest partners. If they're showing it to you, why are they doing it? I mean, why are they extending this glorious opportunity, which is a 5x or a 10x to you? Why are you so lucky? Why are you so special? You should always ask that question, saying that, is this a potential lemon that I'm being shown? And sometimes the answer may be no, that someone genuinely wants to build a good relationship with you and therefore is showing a genuinely good opportunity. But oftentimes it may not be. So then you keep your eyes and ears up and then think about why that's happening. So there are a number of these things. When you see companies representing data in a cumulative basis as opposed to a cohort basis, often a red flag, which means that the cohorts are poor, or company only showing, talking in very vague high level terms without getting into specifics, or trying to rush you into doing a deal and saying, okay, why don't you sign the term sheet? We'll figure out the details later. Again, usually a red flag. Because when numbers are good, people talk numbers. When numbers aren't good, people talk story. So, yeah.
Thanks for answering that. So, Utsav, in the last few minutes, if you could just spend like 30 to 60 seconds talking about the opportunity on Web3, even though it might be tentative, might be helpful. And I see Millie's also raised her hand, and I know you mentioned that you're okay going, overboard by 5-10 minutes, so we can then also take Millie's question.
Okay. So let me take the Web3 question first. We are thinking about an internship. I was the last intern in the firm in 2015. We subsequently haven't had interns, but now we are actively thinking about it. But it's yet to be finalized, right? So I can't formally commit yet. But the plan, because we're spending so much time in Web3, we'll probably deploy $1 billion in Web3 and crypto. We wanted to have someone on board who can help us in our mapping exercise globally. They'll probably spend 2 or 3 months over the summer with us. And then assuming we have a spot next year and assuming the performance of that person is good, you obviously need both. It might lead into a full-time offer. It's also possible that, look, the performance of the person is great, but we don't have a spot. Then it won't convert into a full-time offer with us. But obviously, we'll do our best to connect you to folks who might be hiring, and obviously, we'll put in a strong word. And it'll be a paid internship, and hopefully, people will learn about doing a market mapping exercise in a firm like ours.
Yeah. And what's the best way for people to reach out or apply?
I guess the first thing is we need to get confirmation that we are actually doing this. But after that, just feel free to send them my email ID.
Okay, sounds good. I'm happy to also serve as a conduit, like for email addresses. I can just share with those who have attended your email address. Great. Millie, you want to ask your question?
Yeah, sure. Thanks for being here, Utsav. I guess my question is maybe a little more personal, so you can respond to the extent you feel comfortable. But can you talk a little bit about like the choice and then maybe the pros and cons of like being based in London, and then at least till date, your fund, say 70% was invested in India. I know like going forward, you talked a lot about the global mandate and all that, but I guess it felt like a bit of a curious choice and is something that I'm thinking about personally as well. So I just wanted to get your thoughts and views.
Yeah, London is a great city. Helps you do US, India. I guess if you have a global mandate, London is a great place to be, because almost no time zone is too far. If you have family in India, it's quite easy to go back over the weekends. I mean, you take a Thursday evening flight or a Friday evening flight, and you're back on Monday morning. The city is clean, generally crime-free. Taxes are a little bit higher than India, but comparable with the US. So overall, I love it. We have a small baby. At some point, hopefully, some of you would think about getting married. Potentially having kids. This is a great place to raise kids. So I almost can't think of a better place for us to invest out of, as well as raise a family in. So this was a very conscious choice, and I think it's the right one for us. It may be different for you.
No, that's super helpful, and thank you for sharing. I guess my question's a bit also around like, does it feel that you're like away from the ecosystem, especially because you're looking at early stage deals and stuff like that? Or, with the world that we live in today, not at all, and you still get access, as you said, to everything and have as much pulse on the market?
Yeah, so we have 6 people in India. That helps. I go to India once every 2 months. That helps. And I'm Indian, so I'm reasonably well connected. That also helps.
No, sounds like it didn't, like, you don't see really the cons of it at all, which is great to hear.
No, not as much.
Yeah, awesome. Utsav, couple of quick fire questions. One, and these are just things that I picked up on your last comments. So you were mentioning one about how clean the regulatory environment is in India. So would love your thoughts on particularly on contract enforcement. So when you as an investor have to manage with a portfolio company where there might be a disagreement, how might you look at that? Or your portfolio company is getting into any sort of legal challenges. So very quick fire thoughts on that. And then the second piece would be around, you mentioned those big hitter companies that you're excited about. What do you see as the long-term play for them? Is it that they keep building out their product for the Indian market and go deeper and deeper into the Indian market? Or do they do something else? So I'd love to close the talk with these two questions.
Yeah, absolutely. Look, contract enforcement in India is an issue. There is no There's no running away from that. I think we're getting better at it. Especially the kinds of companies we deal with are generally, hopefully entirely above board, and do business the right way, right? So at least in our dealings with them, it's been extremely smooth. Even if sometimes there are some difficult conversations you have to have, and honestly, that's part of business and that's part of life, right? But in our limited experience of dealing with our companies, we haven't seen contract enforcement per se being an issue of saying that, look, SHA says X and company trying to violate it, right? So things like that we've never seen. And look, sometimes there may be a disagreement and there's always a way to solve it, right? Before you actually go down the legal route. That's one. Second is, the broader question of contract enforcement in India. I think it's getting better. I guess more people are realizing it, recognizing it, but it's still, I would say, a long way away from where it should be, right? I mean, we are still among the lowest in those contract enforcement portion of the ease of doing business rankings. Overall our ranking is improving. I get that, but the wait for contract improvement is still a long journey. I think it's more cultural than anything else. A lot of people say, so those cultural aspects, I guess, have to get fixed before, people start respecting contracts in letter and spirit.
Great. And then the second piece was around, the companies that you mentioned. How do you see them evolve? Do they keep building for India or do they start expanding internationally?
We are seeing both, actually. So Lenskart, as an example, obviously the dominant eyewear platform in India, is now expanding to Southeast Asia, Middle East, Japan, potentially the US, etc. Moglix is doing the same, expanding to Southeast Asia, Middle East, and a number of other markets outside India. So we are seeing that quite actively. There are certain companies within India, they are doing things which are outside outside of what they started with, right? Swiggy, for example, was doing food delivery originally. Now it does grocery delivery, milk delivery, meat delivery, everything, pharma delivery, etc. So then from Swiggy standpoint, what they've built is a last mile pipe to the Indian customer. If you're sending food through that pipe, why can't you send parcels? Why can't you send groceries, milk, meat, etc. Right? So then you're broadening your TAM, you're getting a greater share of the customer's wallet, and you're utilizing the existing driver infrastructure and the capacity that much better. So it makes a lot more sense. So we are seeing both, and we are quite excited by it. Ola, for example, is in a number of countries. Ola is in UK here, Australia, New Zealand, obviously dominant in India. Ola is doing a number of other things outside of ride sharing. Now it's getting active into financial services through its acquisitions of Ola Financial Services and Avail. Ola has gotten into Ola Electric, in terms of two-wheeler electric scooter manufacturing, food, quick commerce, etc. So I think a lot of companies will surprise you in terms of how large they become over time.
Yeah, no, that's thanks so much for sharing those comments, and thanks so much for taking the time out to do this. I know it's now past 11 your time. It's pretty late in the night, so thanks so much for being with us, and thanks to everyone who attended and stuck back even after we passed the allotted time. So thanks everyone, and again, this was a great session.
Thank you very much. I appreciate you having me. All the best.
All right.